Most breakout traders focus on one simple question: did price break above resistance or below support? But the real challenge is not finding a price movement. The real challenge is understanding whether that movement represents a meaningful change in market structure. Today, we are opening the engine bay of a TradingView community script, Liquidity Breakout PRO with volume Confluence. Unlike simple breakout tools that only mark price crossing a level, this indicator combines several layers of market analysis: confirmed swing structures, volatility-adjusted breakout filtering, volume confirmation, and automated risk-reward visualization. In this episode of Chart Science, we will analyze how this system transforms market structure into a complete visual framework. We will examine its internal Pine script architecture, understand the logic behind each component, and evaluate where this design works well and where limitations appear. Before analyzing the indicator itself, we need to understand the problem it tries to solve. Traditional breakout trading usually begins with a simple idea: identify an important high or low, then wait for price to move beyond that area. However, markets often create complicated situations. A candle can move above a previous high and immediately reverse. Price can also break a visible level temporarily before returning into the original range. These situations make breakout analysis difficult because the same price movement can represent two completely different scenarios: a genuine expansion of momentum or a short-term liquidity movement. Liquidity Breakout PRO attempts to organize this information by adding structural confirmation before creating a breakout setup. The first layer of this indicator is market structure detection. Instead of reacting to every minor price movement, the script focuses on confirmed swing points. Inside the code, the system uses Pine script pivot functions, TA.pivotHigh and a .pivotLow. These functions identify potential turning points by comparing candles around a specific area. The important word here is confirmed. A pivot high is not created immediately when price reaches a temporary high. The script waits for additional candles to confirm that this area represents a meaningful swing point. In the default settings, the indicator uses 20 candles on both sides of the pivot calculation. This creates fewer but more significant structural levels. This design introduces an important trade-off. Stronger confirmation creates cleaner market structure, but stronger confirmation also means slower reaction. Because pivot levels require future candles for validation, the indicator naturally cannot identify every turning point instantly. This is not a coding mistake. It is a design decision. The developer chooses structural reliability over maximum speed. Like many technical tools, the user needs to understand what type of information the indicator is designed to provide. After a structural level is created, the next question is: when does the indicator consider that level broken? The script uses a combination of price close confirmation and optional ATR buffering. Instead of reacting when price simply touches a level, the system waits for the candle to close beyond the swing area. The ATR buffer adds additional distance based on recent volatility. This helps reduce signals caused by very small movements around the level. The goal is not to eliminate every false breakout. The goal is to create a more structured breakout condition. A breakout alone does not always represent real market strength. Many false breakouts happen when price moves beyond a key level, but market participation remains weak. This indicator adds another layer of confirmation by checking volume conditions. When breakout momentum is supported by above-average volume, the signal becomes more meaningful. However, volume is not a prediction tool. It only tells us whether more market participants are involved during the move. After a breakout signal appears, the indicator does not stop at showing an entry point. It automatically creates a complete trade structure. The red area represents potential risk. The green zones represent possible target areas based on Fibonacci expansion. One interesting design choice is that targets are calculated separately from stop loss. This means increasing the stop distance does not automatically create unrealistic profit targets. So how should traders approach this tool? The first step is not entering immediately after a signal appears. The indicator should be treated as a structure mapping system. First, identify whether the breakout happens around an important swing level. Then observe whether volume supports the move. Finally, evaluate the risk and reward structure before making any decision. A breakout signal is only one part of the analysis process. Now it is time for the chart science evaluation. Instead of asking whether this indicator is profitable or not, we analyze the engineering behind it. First, visual design. The indicator creates a complete breakout workspace directly on the chart, including levels, risk zones, and targets. Second, logic innovation. Combining swing structure, volume confirmation, and risk management creates a more complete framework than a simple breakout line. However, the limitation is also clear. During sideways markets, price can repeatedly test levels and create false breakout conditions. If you want to explore this indicator yourself, you can find the TradingView link in the description. If there is a specific TradingView indicator you would like us to analyze, feel free to leave a comment below. We will continue exploring interesting tools and breaking down the logic behind how they work. This is Chart Science, where we decode trading tools beyond the signals.